Hello, this is Mark Sobel. I'm the U.S. Chair of OMFIF. Today, I'm delighted to be joined by Roberto Perli, Head of Global Policy Research at Piper Sandler, to discuss yesterday's FOMC outcome. Roberto is one of the best analysts of U.S. monetary policy, a longtime leading U.S. macroeconomic expert, and at one point in his distinguished career, a senior staff member of the Federal Reserve Board, assisting in the formulation of U.S. monetary policy. So welcome, Roberto.
Thank you, Mark. It's a pleasure to be here. Thank you for inviting me.
Our pleasure. So yesterday, we saw what happened. The Fed raised the federal funds rate 75 basis points. There's a new dot plot with a much higher terminal rate. Unemployment goes up, income growth goes down. Core inflation reverts to near 2% in 2025. So we'll come back to the dot plot, inflation, labor market specifically. But just what's your overall reaction to yesterday's FOMC outcome? Anything surprising, caught your attention?
No, I mean, I think the outcome in general was more or less as I think the market more or less expected it. I think it was a little bit more hawkish in the sense that they communicated a higher peak rate than the market had in mind. But look, I mean, I think the Fed yesterday did what they had to do and stay hawkish, right? So inflation is way too high. The labor market is still very good, maybe too good, right, in some sense. And so I think the Fed acts as if it is a single mandate central bank at this point. And that's that's the message that came out yesterday. I thought it was interesting that Powell gave his prepared remarks, and then before answering any questions, he added, "Hey, just for the avoidance of doubt, my stance has not changed in Jackson Hole." Right. So he gave a very clear, short, concise, to the point speech at Jackson Hole. The market understood it, and his top priority was to make sure there were no misunderstandings this time. The attitude does not change, completely focused on bringing inflation down.
Well, great. So let me ask you about your thoughts on the latest dot plot. The median Fed funds rate this year goes to 4.4 and 4.6 next year. There are lots of debates about where the Fed funds rate will end up. Markets are below the FOMC. As you just said, my sense is that many prominent economists think that the markets are too sanguine and the Fed will have to go higher than even 5%. So what are your views on that? And what's your terminal rate?
Well, so what's my view of the terminal rate? I mean, I think 4.6% is reasonable. Right. So how do they get there? So why 4.6%? I think the reason, the rationale is we need to go above neutral. Obviously, short-run neutral is a lot higher than long-run neutral. Long-run neutral is still about 2.5%, but in the short run, we're significantly higher than that. How much higher? Probably in the 4% range, because short-term inflation expectations are not as high as inflation is today, but they're still well north of 3, close to 4%. So real neutral rate, according to markets models, probably 0 to maybe at most 0.5%. And so add the two together and you get something north of 4.5%. And so 4.6% meets that threshold. And so that's how I think they arrived at that number. So I take it seriously. I would also say, given that, given the way inflation is going, I think probably 4.6 is kind of a floor more than a ceiling. So in other words, things could go higher if inflation continues to prove more persistent than the Fed thought, and pretty much a lot of people think. But yeah, so I think as a base case, I think it's a reasonable number. In terms of what they projected for the end of this year, so they had 4.4, as you said. The median is very weak, right? So the committee seems to be equally divided between people, a group of people that thinks we need to add another 100 basis points from here, another equal size group that thinks that we should add 125. So when the committee is that divided, obviously we cannot be very sure that 4.4 will be the peak rate, that will be the rate at the end of the year. I think a lot will depend on the next couple of inflation reports, and secondary, the next couple of jobs reports. I mean, that's a recipe for volatility, right? So we don't know what the data are going to tell us. So the data are going to be bad on inflation like they were last time. I think, yeah, we're going to end the year at 125. If the numbers are a little bit more encouraged, we end the year 100 basis points higher than today. But that's the margin for maneuvers, relatively small. I think what matters the most is where the peak rate will be, and I think 4.6 or higher is reasonable.
So you just began to touch on it, but maybe you could elaborate on your views on U.S. inflation dynamics. How much of this is demand pull versus cost push, whether you fear second round wage effects, de-anchoring price dynamics. How does this shape your views on the outlook? I mean, is it the case that inflation is more entrenched than many had thought, and this means we're in a higher for longer world?
Well, I mean, I think there is a risk, right, that inflation expectations become entrenched, or inflation expectations become unanchored, if you want. I mean, I don't think we can say that based on the data that we have, both surveys and certainly markets. If you look at markets, break-even rates, of course, they are contaminated by liquidity premiums and other extraneous components. But even if you try to strip them out of those extraneous components, they're pretty well behaved, higher than they were pre-COVID, but not completely out of the realm of what's acceptable. If you look at surveys, I should mention also inflation swaps, not break-even rate, but inflation swaps, they come down pretty quickly, right? So the market thinks, hey, a year from now, we should be well under 3% and close to 2.5%. If that happens, that's great, right? So that's good news. If you look at surveys, same things, right? So the long-term expectations increased a lot, but they have come down the last couple of months. Maybe not yet to levels where the Fed would be comfortable, but certainly better levels than they were. And even the short term has shown some signs of coming down. So expectations are well behaved. That's encouraging. But at the same time, obviously, inflation, especially core, right? So the last CPI report was bad in the sense, headline inflation came down because of energy, but core inflation did not. Like, so the month-on-month number was 0.6%. The last 3 months, core CPI annualizes to 6.4. That's just not even remotely acceptable from the point of view of the Fed. So I think that's what makes them nervous and induce them to continue hiking at an aggressive pace. So is it all demand? Is it demand and supply? It's hard to tell, but I think there was an interesting New York Fed piece not so long ago where the estimate was probably 60% demand, 40% supply, right? And I mean, I think I don't see a reason to disagree drastically with that breakdown. I mean, I think supply issues were much more pronounced months ago. They seem to be slowly alleviating, but on the demand side, if you look at wage growth, for example, pick your favorite measure, but anywhere between 6.75% of the Atlanta Fed wage tracker. That's a lot higher than in previous cycles, right? So I think that makes Fed nervous as well, which is why you hear Powell repeating many times, and there's some pain in the labor market, some worse conditions in the labor market are probably needed here to bring inflation down.
Well, great. That's a perfect segue into a question on labor markets. I mean, do you have views on the Summers-Blanchard argument that the labor markets are going to have to undergo considerable pain to get inflation to revert to 2% versus kind of the Waller's argument that a soft landing is possible with the decline in vacancies and with the surge in unemployment. The dot plot put unemployment, I think, up to 4.4 or so. Is that pain? I think it crosses the SOM rule threshold. But Powell admitted yesterday that there needs to be pain, but he pushed back on what I would call a heavy pain view, arguing that the very high openings, the Russia's invasion, and the impact on commodity prices, supply chain woes, and inflation expectations being well anchored suggested that this time was different. Do you have any views on that nexus of issues?
Yeah, well, look, but first of all, with respect to what Powell said yesterday, I mean, I would be shocked the day I see a Fed chair, going on a press conference and saying we're going to have an enormous increase in the unemployment rate, right? So that's probably don't want to say that, even if you fear that that's a possibility. But look, I think in general they are right. So there is a path to a soft landing, and I think the Waller paper that you refer to, Figura and Waller, showed that such path exists. Now, I happen to think that such path is narrow, it's hidden, and it's very hard to find. It takes a lot of luck, but it's there. So hopefully, we'll get there. But I think even the Waller paper itself, I think it was a very honest paper, right? It said, look, under a certain set of assumptions, the increase in the unemployment rate will be modest, and so compatible with a soft landing. But under different sets of assumptions, the increase in the unemployment rate will be much larger and totally not compatible with a soft landing. So I think that was the way I read the paper is, look, there is a path, but there are many other paths that leads in some very different direction. Right? So it's a matter of assumption. Obviously, Figura and Waller believe that the assumptions that lead to a soft landing are realistic. I think Summers and others disagree. I think I'm probably skeptical myself, right? So there's when we talk about assumption, we talk about things like matching efficiencies, the extent of the decline in the vacancy rate, where will the job finding and loss rate go? So we don't really know, right? These are very hard to measure variables, and so again, there are some configuration of these variables that lead in a constructive direction, but many others that don't. So I think and I should say, the more the Fed is forced to raise rates, the more the Fed is forced to remain at a higher rate, the longer, right, forced to remain there, the harder to find the soft landing path becomes. So personally, I'm a little bit skeptical that we'll find it, but certainly I think we're all here hoping that Fed will find it.
Thanks. I've read quite a few recent commentaries suggesting that with central banks acting so forcefully and not necessarily taking into account the interactions and these spillovers at the global level, that there may be excessive tightening with implications for growth and unemployment. Do you have any reactions to that argument?
Well, there has to be excess tightening if we want to bring inflation down, right? So that's the way it is. We got to a point where inflation got too high, and so at this point, I don't think central banks, the Fed, or anybody else has any choice, right? So if you want to bring inflation down, which I think we can all agree is the best thing to do from the longer term well-being of the economy, then you have to hike above neutral, so excess hiking, and you have to tolerate the risk of pushing the economy over the edge. Hopefully, it will not be. I don't think it will be, if it happens, a massive recession. It will be nothing like the last two recessions. Much more of a ordinary, quote unquote, recession where growth stalls or go slightly negative, the unemployment rates increases, I think, more than the SEP suggests, but still no more than say a couple of percentage points. So yeah, some mild recession, but it happens. So I think central banks have no choice. But many times, I hear the argument too. So are the central banks making a mistake in tightening so much? Are there not lags in the transmission of monetary policy and all these things? Of course there are lags, but again, we have no choice. The mistake, I think, if you want to call it that way, was made earlier by allowing inflation to get to this point. Of course, it's easy to talk about mistakes with the benefit of hindsight. When you have to make policy in real time. I think what Fed and other central banks did was perfectly reasonable at the time. But given that we got to this point, I think there is no choice now.
And I take it that you're probably a bit in the skeptical camp that central banks can work together across borders to address these spillovers and take them into account in their own monetary policy formulation.
Look, I mean, the subject of central bank coordination, policy coordination across central banks, I think is very fascinating. I think it strikes the fantasy of many observers, right? But I think the threshold to actually get to a true coordination is very, very, very high, right? So the central banks are different, have different mandates. They have different economies to deal with. They have different internal objectives, right? So it takes quite something very extraordinary, like, for example, the Great Financial Crisis, to get to a true coordination. I think right now, central banks certainly keep lines of communication with each other wide open, talk to each other. But I suspect the current situation does not rise to the level of basically getting all around the table and say, okay, I do this, you do that, and let's do it all at the same time, right? So they're all in the same boat. Inflation is high everywhere. And all of them, with one notable exception, Bank of Japan, are doing the same thing, but in slightly different ways because their domestic priorities are different. So yeah, you're right. I'm skeptical about coordination here.
So it seems that the Federal Reserve and the ECB have somewhat abandoned forward guidance for data dependence. What's your view on that forward guidance, and any thoughts on what your take on current Fed communications?
I'm looking here at what Chair Powell said at Jackson Hole, and he said restoring price stability will likely require maintaining a restrictive policy stance for some time. Well, that's forward guidance, right? So yes, we abandon it, but not, we abandon maybe more precise forward guidance. Maybe we abandon short-term forward guidance, but we didn't abandon forward guidance completely. So I don't think the central banks will ever abandon forward guidance completely, right? So I think it's a useful tool to manage expectations. You don't want expectations to get completely out of whack with what you think or what you think they should be. And so I think forward guidance is here to stay. But at the same time, I think the central banks are not in a position to say, hey, at the next meeting, we're going to do this, we're going to do that. I mean, they tried at the beginning of this cycle, but I think classic example of why you shouldn't do it is the June meeting, right? So guiding to 50 basis points, and then all of a sudden you get a bad inflation report, you get bad inflation expectation surveys, and you're forced to change like 2 days before the meeting. So yeah, I think short-term forward guidance probably is hard to give at this point. I don't think the Fed will continue, will give it for quite a while, but the longer term is still useful to give a sense of what the Fed wants to do, or any other central bank they want to do in the longer term.
So the Fed has basically suggested that quantitative tightening is going to run quietly in the background. I've seen reports or studies that suggested a 2.5 trillion balance sheet reduction is equal to about 50 basis points on the Fed funds rate. Now, I assume, of course, that if conditions change, the Fed won't have QT running in the background anymore on autopilot, for example. But and so that's one point. Another is that there's quite a bit of fiscal retrenchment occurring in the U.S. right now. So do you have any thoughts on the Fed's QT? But also, do you think that with QT and running in the background right now, and with fiscal retrenchment, that there's going to be a greater jolt to the U.S. economy than people are thinking about right now?
So first of all, look, I kind of agree with your 50 basis points equivalence, right? So, but what I would say is those 50 basis points have already happened, right? So I think the market internalized the whole effect of QT, of expected QT, between, say, September of last year and May. So over that period of time, the Fed went from no tapering, faster tapering, no QT, faster QT, the final announcement of what QT will be. Over the period of time, term premiums increased, as they should have, and that was the effect, right? So since then, term premiums have actually come down, most likely because the market increasingly fears a recession, and so safe haven flows, like that type of argument. So yeah, so I think the effect of QT already happened. So at this point, I would say the risk is that the assumptions that translated into 50 basis points equivalent tightening will prove probably too strong, in the sense that probably QT ends sooner than people thought just a few months ago, because, hey, there is probably going to be some sort of recessions. And if there is a recession, well, what's going to be the policy sequence? Well, the first step is to talk less hawkishly or more dovishly. But the second step is to stop QT well before you want to cut rates, right? So probably QT doesn't last. My personal assumption is it doesn't last beyond next year. Of course, we'll see. It depends on the circumstances. But if the Fed does not find that narrow path that leads to a soft landing, QT probably ends next year. And so from a point of view of the impact, those 50 basis point estimate is too high, needs to come back. And so that would be another reason why probably longer term rates decline a little bit in that situation.
All right, well, we're coming to an end. So last question, maybe kind of a sum up kind of question. You think back to the 70s, we had stagflation. People allege the Fed didn't stick to it. The 80s, you have Volcker wringing inflation out of the economy. From a risk management perspective, I think I've heard you suggest that you basically see that perhaps we're going to overshoot, but that's a necessary evil. And that might incline you to be more in the harder than softer landing camp.
Yeah, I think that that's where I am, personally. Again, I hope I'm wrong, but if I have to analyze the probabilities, I think I think that's where we're going. Look, even from a pure historical perspective, right? So it's debatable where neutral is, right? But since the early 60s, there has been only one true situation where the Fed has hiked above neutral and a recession did not happen. And that was the 94-95 tightening cycle, when the economy was helped massively by this big increase in productivity, the like of which we're not seeing right now, right? And even then, I think it took quite some luck to stop at the right time, right? So I think the odds are against a soft landing, but again, hope we can get it, regardless of regarding whether we're talking about 70s or 80s. Look, I think the Fed seems to be, the FOMC seems to be unanimous completely unanimous in say, hey, we need to bring down inflation. So unanimity doesn't happen very frequently in any committee, especially the FOMC. Everybody, doves, hawks, everybody in the middle, they're saying all exactly the same things. Of course, look, it's very easy to say hawkish things today when the labor market is very strong. I think it will become harder as the labor market deteriorates. I think the political winds will shift as well. That will be a further obstacle. But I think the Fed has the determination to reenact the Paul Volcker's years, of course, with the due proportions, right? So we're not talking rates of 20% or anything like that. But I think the attitude is much more similar to the 1980s, early 80s.
Well, thank you for that. Well, I want to thank you profusely for joining us today. You probably have real work to get on to for the rest of your day. So thank you for joining us. And thank you for your wonderful overview of the yesterday's FOMC. Thank you.
No, thank you. And that was great to be here, and certainly wasn't a waste of time. I'd much rather do many of this than some part of my regular job. So thank you.
Well, that's a real compliment. Thank you again.
Thank you.